If you looked at your paycheck recently and wondered why your employer is suddenly taking more money out of it, you are not crazy. On January 1st, 2026, the largest tax code change in recent American history silently went into effect, and it is going to absolutely devastate your finances this year. The federal government just cut your standard deduction by exactly 50%. That means if you are a married couple, the nearly $30,000 of your income that was completely protected from the IRS last year is now sitting completely exposed to federal taxes. At the exact same time, federal tax brackets have officially jumped back up, with the top rate increasing from 37% to 39.6%. If you do not adjust your tax strategy right now, this hidden 2026 tax hike is going to cost you thousands of dollars. Welcome to Clear Path Tax, where we expose exactly what the IRS is doing with your money and how you can protect it. Right now, millions of Americans are experiencing extreme sticker shock. And it is all because of something called the TCJA sunset. Back in 2017, the government passed the Tax Cuts and Jobs Act, which temporarily lowered taxes for individuals and families. But there was a catch. Those cuts came with a strict expiration date of December 31st, 2025. Because Congress failed to pass a new law to extend them, all of those tax breaks officially died at midnight. Now that we are in 2026, the tax code has reverted back to the brutal old rules, and the IRS is already adjusting their withholding tables to take more of your money. The most catastrophic change for the average American is the total destruction of the standard deduction. For the last few years, nearly 90% of taxpayers stopped itemizing their deductions because the government gave everyone a massive automatic free pass. Last year, a married couple filing jointly could deduct nearly $30,000 right off the top of their income tax-free. A single filer got a free pass on nearly $15,000. Today, in 2026, both of those numbers have been slashed in half. You now have significantly less protected income, which mathematically forces a massive chunk of your hard-earned money directly into taxable territory. To make matters worse, the IRS is not just taxing more of your money, they are taxing it at a significantly higher percentage. The tax brackets themselves have snapped back to their pre-2018 levels. If you are in the middle class, the 22% tax bracket you enjoyed last year has now jumped up to 25%. The 12% bracket is back up to 15%. This means even if you did not get a raise at your job and your salary stayed exactly the same, you are automatically taking home less money every single month because the federal government has increased their mandatory cut. If you have children, the 2026 tax shock gets even more expensive. Under the old rules, parents received a very generous $2,000 child tax credit for every qualifying dependent. As of this year, that credit has been violently slashed in half, dropping straight down to $1,000 per child. Furthermore, the income thresholds have been severely lowered, meaning millions of middle-class families who qualified for this credit last year will now find themselves completely phased out and disqualified from receiving a single penny of it in 2026. Small business owners and freelancers are also getting completely wiped out by this sunset. If you operate an LLC, an S-Corp, or work as an independent contractor, you likely took advantage of the Qualified Business Income Deduction, known as QBI. This massive loophole allowed business owners to wipe out 20% of their business income entirely tax-free. As of 2026, the QBI deduction has been completely eliminated. Every single dollar of profit your business makes is now subject to your highest personal income tax bracket, which, as we just established, has also gone up. There is only one specific group of people who might actually benefit from these 2026 changes, and that is high-income earners living in heavily taxed states like California, New York, and New Jersey. The expiring law also eliminated the $10,000 cap on the SALT deduction, which stands for state and local taxes. If you pay massive amounts of property tax and state income tax, you can once again write all of it off on your federal return. However, for this to actually save you money, you now have to go back to the old, painful method of manually itemizing every single deduction on your tax return instead of just taking the standard deduction. You cannot wait until you file your taxes next year to fix this, because the financial bleeding is already happening on every single paycheck you receive right now. Your first line of defense is to immediately contact your HR department or log into your payroll portal and update your W-4 form. You need to run a new tax withholding calculation based on the new 2026 brackets. If you do not update your withholdings, you are going to be hit with a massive unexpected tax bill and underpayment penalties when tax season rolls around next year. To survive this tax hike, you must aggressively focus on artificially lowering your adjusted gross income. Since the government took away your standard deduction, you have to create your own tax shelters. This means maximizing your pre-tax contributions right now. Every dollar you put into a traditional 401k, a traditional IRA, or a health savings account is a dollar the IRS cannot touch. If you own a business, you need to sit down with your tax professional immediately to reevaluate your entity structure, because running as a standard LLC in 2026 without the QBI deduction is financial suicide. The rules of the game have completely changed, and ignorance will cost you thousands. If you looked at your recent pay stub and noticed the IRS taking a bigger bite, let me know in the comments below. Do not let the government quietly take your wealth. Subscribe to the channel right now, turn on your notifications, and join me in the next video where we will break down exactly how to itemize your deductions this year to legally steal back your money from the IRS. Another massive trap that is quietly coming back from the dead in 2026 is the alternative minimum tax, commonly known as the AMT. For the past 8 years, the AMT exemption thresholds were pushed so high that almost no one in the middle class ever had to worry about it. But because the tax code has reset, those exemption levels have crashed back down to reality. If you earn over $100,000 a year, have multiple children, or live in a high-tax state, you are now squarely back in the IRS crosshairs for the AMT. This means you will literally have to calculate your taxes twice, once under the regular rules and once under the AMT rules, and the federal government legally forces you to pay whichever number is higher. If you have been working your entire life to build generational wealth, buy real estate, or pass down a family business, this 2026 tax shock is coming directly for your legacy. The lifetime estate and gift tax exemption has just been violently slashed by 50%. Last year, an individual could pass down nearly $14 million to their heirs completely tax-free. Today, that protective shield has plummeted to roughly $7 million. While that might sound like a problem only for the ultra-rich, if you factor in the value of your home, your retirement accounts, life insurance policies, and a successful small business, your net worth can easily cross that new, lower threshold. If you do not sit down with an estate planner immediately, the IRS is waiting to take 40% of everything you built before your children ever see a dime. But there is one tiny sliver of hope buried inside this massive tax hike, and if you are smart, you can use it to fight back. Because the old tax rules have officially returned, the IRS is once again allowing taxpayers to claim miscellaneous itemized deductions, subject to the 2% floor. This is a massive win for W-2 employees who have been suffering for years. You can finally write off unreimbursed work expenses again. If you buy mandatory uniforms, pay union dues, purchase tools for your job, or even pay fees to a financial advisor or a CPA to prepare your taxes, you can legally deduct those costs. However, the IRS is not going to just hand you this money. You must meticulously track every single receipt starting today, because without proof, those deductions will be instantly denied in an audit. The brutal reality is that the 2026 tax landscape is a financial minefield, and the days of easy automatic tax breaks are officially over. You can no longer rely on a simple online software program to just click a button and expect a massive tax refund. You need a proactive, aggressive tax strategy, and you need to start implementing it on your very next paycheck, not next April when it is already too late. If you ignore this, you are voluntarily handing over thousands of dollars of your own wealth to the federal government. Do not let them quietly drain your bank account. Hit that like button if this video opened your eyes. Make sure you are subscribed to ClearPath Tax to stay ahead of the IRS. And drop a comment below telling me which of these 2026 tax changes frustrates you the most.